Hey guys, welcome to Johnny's Calculated Brain V2. The primary reason this is V2, by the way, and I'm calling it V2 rather than just an extension of the toolkit we already had, is because it introduces a full decision-making framework. It's not enabled on the chart just yet, so you won't be able to see it, but I'll be switching that on shortly. But first, we're going to go through everything step by step again, with the entire toolkit and a full walkthrough, because the V1 tutorial is now somewhat outdated since some changes were made. But before we begin, something very important: this is a toolkit. It's not a buy or sell indicator. Although you have buy or sell signals as part of the toolkit, you cannot use those blindly without structure and context. The buy and sell indicators and automated algos that, blindly work for you, they don't exist. No automated system will ever replace the actual point behind decision making, which is why we've come up with a decision making framework. You could, in theory, go and find the best trader alive. You can resurrect one from the dead if you want, or find one in a parallel universe, but none of them will give you something that just blindly prints money. That's not how markets work. That's not how anything works. And if it were that easy, you wouldn't statistically have more than 95% of traders losing money. But before we go through each module and the framework, one other thing to understand is that a framework is basically useless without a working strategy behind it, which is why we had to actually build one that works to prove that the framework itself behind decision making works. Because if there isn't a working strategy behind a decision-making framework, then you need to actually prove that the decisions work, and without that you can't. So this took a lot of work, but alongside the framework, you're also getting a repeatable strategy that you can apply consistently. And I'll say this, from V1, new traders who had never traded before were able to turn over around 8 to 10% of their portfolio within a few weeks, and the more experienced traders that we had as part of the group, they were able to pass their FCMO 100k challenges. I think we had at least 3 or 4 of those. So the foundation, even prior to this new update, works absolutely fine, and it's a very powerful toolkit. And before we start going through each module properly, let me just briefly explain what an indicator is, right? This is a toolkit, but let me explain what an indicator is. For example, let's take the RSI indicator or the momentum-based indicators, which are very popular for day-to-day use amongst retail. They're essentially just calculations, numbers, which are then brought into a visually calculated displayable format, and then the lines that you see along with the threshold within, let's say, your RSI indicator, that's all of those numbers, maths, brought into a visually readable format. Otherwise you just have raw numbers and you can't interpret raw numbers. So the entire point behind the toolkit from the very beginning was to make the market as easy as possible to read for clarity, and to basically be able to use the structure and context, because technically everything that you see on the chart is structure and context. It's price action, right? But to actually be able to use it in favor by visually being able to map out what people might take, an hour or 2 a day drawing out manually. The whole point of the toolkit was to do all of that work beforehand, and then for the decision-making process to start. So the decision-making framework wasn't there before, now it is. We'll get into that shortly. But yeah, let's begin with what we have here. So we'll begin with the most basic thing, which is trend lines. You've got automated trend lines. So for example, here you've got a major trend line. Here's another major one, and the minor trend lines are these dotted ones that you see here. So dotted trend lines that you see here, they're minor trend lines, and these dashed ones are major trend lines. And these are automatically drawn for you regardless of which time frame you go on. If you go on the 4-hour chart, for example, the trend lines there would also be drawn for you. As you can see here, minor trend lines there, and you've got your major trend line that's crossing over here. And as we can see on what we're looking at, gold, it's currently crossed that trend line. And it also closed the gap here. So this was actually the easiest trade you could have taken, even without a decision-making framework. You had an opening gap, the gap closed, bounced off the trend line on the 4-hourly, continued up. I mean, the trades don't get any easier than that, right? We had the same on silver. If I quickly show you silver, and there's a trade I took within the group last night. I think it was, yes, it was last night. And the logic behind it was just so simple. You had an opening gap, the gap was closed, you had the trend line, perfect bounce, you were within a bullish brain zone, wasn't mitigated, because the mitigated ones, they appear in grey, the ones that haven't been, they still appear in their original colours. So yeah, gap closed, bounce off the trend line, boom. The trade-in doesn't get any easier than that. That was a very easy setup. So yeah, you do get those a lot of the times. And the guys that, usually trade around opening day gaps and things like that, they'd understand this pretty clearly. So yeah, trend lines, okay, very important. Many people, they don't draw them accurately, they don't draw them precisely enough. This makes sure it's actually drawn wick to wick precisely, but it cannot, get it wrong. Wick to wick, factoring in candle bodies as well. So yeah, that's the automated trend lines for you. One change here compared to earlier is that they're now more visible. So I've made that slight change for trend lines. Previously, they weren't as visible. They were quite faint. That's no longer the case. They're more visible now as part of the default settings. Although you had the option to make them more visible, even in the old version, you would literally just have to go down here, and the major line type and minor line type, you could have changed the type, you could have increased the visibility. Previously this was set to 1, it's now set to 2 by default. There have been some other changes, but we'll get into that bit by bit. So let's go back onto the gold chart, because the silver one's too noisy. I don't like that. Just easier to explain things when using gold as a reference, because the price action is a little less choppier. So let's start with brain zones. These are brain zones. So here you've got a green bullish brain zone. There you had a big red brain zone, which is now grey because it's been mitigated now. But before that, it would have been a red block, similar to this green block here. What are brain zones? They're basically just imbalances. They're fair value gaps. It's as simple as that. They're fair value gaps. But the reason they're named brain zones and are the foundation of this toolkit is because they're volumized. They factor in internal volume, which actually creates the fair value gaps, which is why you see some blocks are larger than others are smaller, and you also see these volumized sort of small bars here to let you know how much a buy volume or sell volume passed through, as opposed to the latter. So they're your foundation. They don't just show where price moved, they also show how it moved and where the real inefficiency sits. So these are your key areas where price is likely to return, react, or rebalance. As you can see here, a bearish one was created. It was retested, continued down. So that was a retest. Here you had a bullish brain zone created. Again, it acted as a magnet. It mitigated it because the 1 hour candle close would have been below it, which is why it's now grey. And after mitigating it, it's now continuing in its usual direction. But we need to zoom out to get a better idea of the context here. So I'll switch to the 4 hour chart. The very first brain zone that was created was actually here. This is the key one. Every single one that is created after is more likely to be mitigated. As you can see, that was the very first one, very impulsive candle, but we've currently got the brain zone time frame set to 1 hour, because this entire strategy depends on the 30-minute time frame for intraday and swing as per your votes. So if I set them to 4 hour whilst trading off the 30-minute time frame, that would be, you'd be waiting for setups forever, and then you're looking at larger swings, not intraday and swing combo. So that was the very first one that was created on the 1 hour chart. After that, it was retested to about half the imbalance. So yeah, roughly half. And then after it retested, it continued, and then it just continued on. Same with this bearish one that was printed here. It printed, and you'll see a lot of the times it won't even get retested. So this is why brain zones are the core foundation. They will always tell you when trend is about to shift. If you're sandwiched in between two, let's say, for example, you've got your bullish one here and then a bearish one printed right after. What matters is what happens after it retests that first one. If it breaks through, it means this bearish brain zone is valid and you're looking at a bearish continuation. If it wicks off, it means this one's valid. That one will be mitigated as it was. You can see it's grayed out, and then it will continue in that direction. And since then, there's been no bearish one printed, right? So the bullish brain zone remains intact. So in short, that's brain zones for you. They're fair value gaps. They act as key areas where price is likely to return, react, or rebalance. And a lot of the times it will just, it will create one because it's so impulsive. It will just continue. If you've caught an event or if you've caught a major move, it won't even revisit it up until much later. For example, here, gold looks like it will revisit this imbalance that was left here, but it's happening much later, not right away, not within a day, right? Whereas in this scenario, one was created within the same day or so. It did retest it and then bounce off. So that's brain zones in short. Now, one thing that's been removed, if you've noticed, compared to what was there in V1, is the inverse brain zone. So inverse fair value gaps were essentially, let's say, for example, this brain zone's been mitigated. It would have turned this bullish one red to show that, hey, I am now your resistance. And as you can see, for a brief moment, it did serve as resistance. It mitigated it, it went back, there was a little wick here, rejected, and then it found its steam again. So what brain zones also act as is, as you can see, they can also act as support and resistances too. So here you've got it acting as support. Here, for a brief moment, it became resistance for let's say 12 hours. No, longer than that, actually. Let's say about 16 hours, up until it broke that resistance and then, found its way forward. So to summarize, the key areas where price is likely to return, react, or rebalance, but they can also act as resistances. If you're sitting below a bearish brain zone, it will act as resistance. If you're sitting above a bullish brain zone, it will act as support. So it's as simple as that. Inverse brain zones, you don't need them anymore. They were just adding noise. They conflicted with the primary structure. They didn't improve execution at all. And removing them actually makes decision-making much cleaner and more consistent because there's less noise and clutter on the chart. Now, the module which got everyone excited last time round was the Johnny's AI module. As you can see, we're currently on the 4-hour time frame. The AI signals win rate is 76%, and the wins and losses, 29 wins, 9 losses. If I flip over back to the 30-minute time frame, 81% win rate, 34 wins, 8 losses. Now, let me explain how this works. And this is important, so you don't blindly start just trading, buy and sell just because the success rate on certain assets are really good. Others, you might find they're 55, 60%. On some, you might find they've been, amazing, 75, 80%, some even higher. The AI module is a machine learning module, which is where the intelligent aspect comes in, right? One part is machine learning, the other part is the intelligent aspect, or the intelligence aspect, based on what it does in the background outside of that. So let me go through that. So the AI module, it basically continuously scans thousands of historical candles, and then it learns from how price behaves. Every new candle updates its understanding, so that's the machine learning module. Every candle is teaching it, so it's consistently learning. And there is a limit to this. There has to be a limit, otherwise TradingView would just bug out, and it would take hours to calculate. If I included 50 years of history in there, let's say, for example, when 50 years, I don't think 50 years of chart history exists, but let's say 5 years, it would completely bug out. It will probably never load. But it's roughly between 2,000 to 2,500 bars. It will basically scan, and then it will continue adapting as price action evolves. So the price action from today becomes your yesterday tomorrow. So it's then learned from today's price action, and will factor that in for any predictions tomorrow. So it's consistently learning, and it's consistently adapting. So it's adaptive. And the reason that module was introduced is because with the market conditions we're facing, you need to adapt. This automatically adapts for you using what it learns on a day-to-day basis, regardless of which time frame you're on. If it's the 30-minute time frame, it will be roughly 2,200 bars on the 30-minute time frame. On the 4 hour, it will be 2,200 bars on the 4 hour time frame, which is, I think, just over a year. And that's basically how it goes. It's not there to replace you, by the way. It's not there to replace you in the sense that, hey, I've said buy, so you must buy now. It's here to support your decision making. That's what it's there for. You are still the decision maker, which is why the decision making framework was so important to build. Now, the AI signals are basically generated when current market conditions match patterns that historically led to favorable outcomes. They are non-painting, by the way. Everything that you will see or are currently seeing is non-repainting. Nothing within this toolkit repaints at all. However, they're not standalone trades, as I've just explained. They're used for timing, they're not used for direction. So you can use them on even smaller time frames to, snipe those entries, but they're not there for direction. The context and the structure, your trend lines, your fair value gaps, / brain zones, your dynamic supports and resistances, which I'll touch on shortly, all of that is your structure and context. Now, the intelligence layer that comes into the AI model is the RSI and momentum tracking that's going on in the background. So it has a filter. Just because historically something matches, it doesn't mean it will throw a signal in there. It will then validate against RSI, momentum, and ADX, momentum strength, in the background to actually decide whether plotting a buy or sell is valid or not. So it's not just the pattern, it's also, there's another layer that will come after to validate whether it should print a buy or sell or not. So that's the intelligence layer, which is why you've got a machine learning / intelligence module, and that's why it's been named Johnny's AI. So that's the AI module. Now, we've covered that, so let's move over to market structure. As you can see, you've got break of structures, BOS. You've also got market structure shifts, MSS. Now, market structure basically tells you who is in control, buyers or sellers. Is it a bullish flip? Is it a bearish flip? So that's context. It tracks how price forms highs and lows and identifies when that structure basically breaks. So If it breaks a previous high or low, that's a structure break. So this is how you basically understand shifts in market behavior. For example, here we had a market structure shift, which was a bearish one. And then when that pivot was breached, it shifted to bullish. Now, the really clever thing about this toolkit is that you don't have to switch over to multiple different timeframes in order to see where the structure is breaking or continuing on each individual time frame. Even if you're on the 30-minute chart, as I am here, you'll see market structure shifts on the 1 hour. You'll also see them from the 4-hour chart. You'll also see break of structures on the 1 hour chart. You'll also see them on the 4-hour chart. You'll even see the ones on the daily time frame occurring on your M30 chart. So no fiddling around and going from M30 to 4-hour to daily. That context is already compiled for you into a single view by design. That's exactly how I wanted it to behave, because when you're looking across 3 different time frames and you're shifting charts, you forget things. And the whole point of this toolkit is clarity. So we don't want to be, shifting around different time frames, trying to remember what the previous time frame had or showed. So that's market structure in short. Now let's go over to VWAPs. VWAPs are very, very powerful for those who have used them or know how to use them or know the context of them. Now, in order to fully explain VWAPs, we probably need a separate tutorial. It's a very broad topic to cover in detail, and it's quite an exciting one too. So if I start speaking about it in detail, I'll probably take up half an hour just speaking about VWAPs, which I don't want to do. So I'll keep it short and simple. VWAPs are basically used for context. They show you where price sits currently. So for example, price is sitting here relative to fair value across different periods. So it's not used as a signal, but as positioning information. And institutions love VWAPs. They actually leave those footprints behind. And the entire system of fair value, which this entire toolkit is based on, is an institutional fair value based toolkit. And the reason for that is because institutions only trade fair value. They don't trade in the middle of nowhere. They don't scalp. They don't retail. They trade in and out for an hour. They trade around prices which make sense to trade around, the actual value of an asset, not what happened within the space of a day. For example, there are, geopolitical, sorry, that didn't come out right. There are geopolitical events going on due to which oil spiked and surged through the roof. That's not the fair value of an asset. That's what's happening on that particular day, but that's not what the fair value of the asset would be. Same with, let's say, if gold surges by $1,000 within the space of a day, is that fair value for the market? No. Would you go to a jewelry store and start buying gold the very day it surged by $1,000? I don't think so. So the concept of fair value is very powerful. Now, what you'll notice with fair value is, look how it respects it. Look how it pulls back to fair value levels. So this is all mapped out in the dashboard here, by the way. You've got your levels already written down, and on the right axis here, they're all color coded. So your weekly is blue. So your weekly fair value at the moment is 4712 on gold. Your monthly is 4704. Your daily is 4749. Now, how it works in practice here is the daily VWAP, which is red, basically is day to day. So each day it resets. The weekly is from week to week, and it will track the value for the entire week. The monthly is from start of the month to end of the month. So it will track the value from the start of the month till the end of the month in terms of fair value and footprints left behind by large moves. And price respects it. For example, let's say you've got the weekly VWAP here in blue. You can see how price has respected this on even a lower time frame. You've got your monthly here. As soon as it broke through, you had impulsive candles, you had several retests. They also act as price magnets, these VWAPs. So if you're context aware, these are very powerful lines to actually have on the chart for the daily, weekly, and monthly. I personally don't pay attention to the daily much. You would if you were trading purely intraday, but otherwise you'd ignore the daily and you'd only look at the weekly and the monthly, which is why a lot of the times Mondays are retracement days. Not much happens, and then from a Tuesday you'll see action building up. Same with the end of the month or start of the month. You'll notice all sorts of random chop because institutional rebalancing is taking place. That's what's happening when you see those crazy choppy candles in both directions towards a month end or on a Friday, towards a month end or the start of the month. It is literally just institutional rebalancing around the concept of fair value, whether they're offloading, whether they're picking up, whether they're reducing exposure, whether they're accumulating more. That's what's happening at the start of each month, at the end of each month, and obviously towards the end of a quarter it's even more aggressive, the rebalancing. So now that we've covered VWAPs, let's begin with the dashboard, which I pointed out earlier when we were discussing VWAPs. So the dashboard is supposed to make things just visually quick to scan and read once you first get onto a chart. It takes multiple higher time frames and maps direction using EMA relationships, then combines them into a single view. So it tells you whether the market is aligned or conflicting. So for example, for multi-time frame on gold, it currently says mixed. That's because the moving averages across at least 2 time frames. So the 1 hour and 4 hour, for example, the 4 hour and the daily. I think the way I did this, I'll probably have to remember now. Yes, this was done mainly around the 4 hour and the daily. So if on the 4 hour chart, your price is below the moving average that is being calculated against, and it's not EMA, sorry, it's using SMA, so simple moving average. If on the 4 hour chart, it's underneath the simple moving average, so it's using SMA 200, but on the daily chart, it's above, that's a conflict, because a lower time frame, let's say 4 hour, which sits in the middle for context and structure, that's saying I'm still below the moving average, but on the daily, I'm still bullish and I'm above it. So that's a conflict between 2 higher time frames, the 4 hour and the daily, so it will show as mixed. If they're aligned, for example, you've got price action above SMA 200 on both the 4 hour chart and the daily, then by default, the multi-time frame bias is bullish, so it will display as bullish. So we either say bearish, mixed, or bullish. That we've covered. These are levels, and obviously you've got your anchors color coded as well on the right hand side of the axis there. Now, structure long term is basically, if I go over to daily for gold, there's bearish on the dashboard, and the reason for that is the last market structure shift that took place for gold was bearish. So on a higher time frame, the daily, the last structure shift was a bearish structure shift. So you see structure long term bearish, and then in brackets 1 day. So that's the daily chart. And obviously the AI signals, win rate, and the wins and losses we've covered. Oh, but one thing I forgot to cover was, how does the AI module calculate the wins and losses, and how is a win determined? So it's very simple. From the very price point and the very candle that you're given a buy or sell signal on by the AI module, 4 candles later, let's say for example you received a buy signal, 4 candles later, if price is still higher than your entry on that buy, that's a win. Same with a sell. If it's a sell signal, 4 candles later, if price is still lower than where you entered at that particular candle close, 4 candles later, if it's still lower than where you entered for your sell entry, that's counted as a win. Now on a 4 hour chart, this is very impressive given that the win rate is 76% on gold, because it means on a higher time frame like the 4-hour chart, after buy and sell signals, 4 candles later, which is 16 hours, wins were basically booked. So that's how it calculates the win rate and the wins and losses. So hopefully that's simple enough. One thing that's very important right at the top there is ADX. Now, what is ADX? Firstly, we're getting ADX from the 4-hour time frame. Wouldn't use ADX on anything lower than the 4-hour time frame, which is why it's literally set only to read off the 4-hour time frame, because anything lower will just give you a lot of noise, and that's not the purpose behind ADX. What ADX does is it measures strength, not direction. So it tells you whether the current trend strength is good enough to trade or not, if the environment is tradable or not, or if the market is just very choppy. So the measure is usually between 0 to 18 for a choppy market, at which point, if it was below 18, ADX wouldn't be green, it would be white, and you'd see the number in white. But because it's over 18, it's basically being displayed in green. So 0 to 18 are usually choppy, non-trending, low strength type environments. Anything over 18, so 18 is the bare minimum, by the way. I prefer using 20 or very close to 20 as the base level, but 18 is the bare minimum ADX should read if you're opening a trade, because anything lower than that means you're trading within a very choppy environment. So that's what ADX is. It measures strength. It doesn't give you any direction. It's literally just trend strength and market strength. And it tells you whether the market is trending or if it's just ranging or chopping. And it's actually critical. ADX is something that's heavily overlooked, but it's critical because most traders lose money by trading trends inside ranges, which is why it's crucial. And now that I've touched on the point of ranges, remember that, because when we get to the decision-making framework in a few minutes, you'll see exactly why ranges are so key to that framework. So let's just quickly cover the SMA 200 line as well. I've just included this as part of the toolkit because I know a lot of people rely on it, a lot of people use it. So you've got your simple moving average 200 lines in orange by default on every time frame, whichever one you switch to. So you've got your on the 4 hour, you've got your on your 30 minute, and so on. Just like, even if you added one yourself, it will still behave the same. There's nothing special about it. I've just included it as part of the toolkit, and I've just added a level for it on the right axis, so it tells you what the current, where it's currently sitting and where that average is. So that's what the orange line is there. So yeah, I mean, I don't really need to explain the SMA 200, but I'll explain it anyway. It's basically long-term reference, so it gives you context on where price sits in the bigger picture. So that's what the simple moving average is over a span of time. So as you can probably see, let's get rid of all these range break alerts because I don't want to reveal that yet. So this entire toolkit, now if you start piecing it part by part, is all about fair value, structure, and context, which are the only things that matter. Now let's touch on what did I have next? Yes, the pivots. So we've got pivots: monthly high, daily high, weekly high, daily low, weekly low, monthly low. So I've automatically mapped out pivot points for you: what the monthly high was of the current month, what the daily high was of the current day, what the daily low was, what the weekly high was of the current week, what the weekly low was of the current week, and what the monthly low is. So you'll see them in different orders because obviously pivot levels change. So that's already mapped out for you. So let's say, for example, you wanted to know what the weekly low was, and it's, let's say, midweek. Now you just hover over it, weekly low, just align your cursor with the bar, with the line there. It's roughly around 4415. I didn't want to plot those on the axis because then the axis gets too noisy and I don't like noise. But yeah, you've got your monthly, weekly, and daily pivot points, which are also very important to structure and context, obviously. Now, moving on, exhaustion. So you'll see these E's printed as labels, and what the E means is exhaustion. So let's say, for example, here you had a grind up, the move exhausted, and then down you went. Here it was a very strong move downwards, but you had exhaustion here for 8 hours, and this would have printed on this candle. So whichever one it prints beneath or over is the candle that it's printed against. And as you know, nothing repaints on this toolkit at all. So once it's printed, it's printed. But still, you have to wait for a candle close. If you saw exhaustion and enter the trade off the back of exhaustion and the candle's still midway and it hasn't closed on the 4-hour chart and you're looking at the 4-hour chart, I mean, that would be a very premature trade to take. Because as you can see here, there was exhaustion, and then for the next 4 hours, there was exhaustion, but then the trend continued. Here, there was exhaustion again, and we had a brief pullback, and then it corrected. So exhaustions, there are alerts for exhaustions, which we'll get into alerts in a bit, but they're very powerful in the sense that if you were to set your alerts on TradingView to exhaustions on, let's say, the 4-hour time frame, and you received an alert saying potential exhaustion on this chart, on this time frame, that basically prompts you to look at the chart for an opportunity. So that's what these exhaustions are for. They're there so that you can look at potential opportunities. And the way exhaustion works is it basically just highlights when price has pushed too far in one direction and maybe running out of momentum. So it tracks momentum in the background along with volume and compares the two along with the current price action to get a calculated output of whether we might be nearing exhaustion on the current move or not. It's not a reversal signal on its own, but it tells you when to be cautious. So that's the most important part. Caution. Exhaustion equals caution. And they're more relevant on higher time frames, such as 4-hour. On a 30-minute, you'll see exhaustion happening very frequently because we're looking at such a short time span. So you've got an exhaustion printed here, you've got another one printed there. None are wrong, because you had an exhaustion printed here, there was a pullback. You had exhaustion printed here, there was a pullback. So it's not wrong, it's just you're looking at a much smaller time frame, so there will be a lot more noise when it comes to looking at exhaustion on smaller time frames. Whereas higher time frames, it's a lot more selective because there's a longer span of time to look over. So that's one of the very important things about exhaustions. So should we move over to what actually changes in this module now? The decision-making framework, which is the big reveal, I guess. Let me enable that. So one thing before we enable it for settings, for those who are using the old settings, I'll tell you what's changed. Brain zones were previously set to 4 hours by default if you just added the indicator in. Now, by default, I've set them to 1 hour because this entire strategy is based off the 30-minute time frame. If we start taking trades using the 4-hour brain zone whilst executing on the 30-minute time frame, you're looking at purely swing setups, no intraday and swing combo. I think I might have said that earlier, but in case I haven't, I'll just repeat it again. So that's why they've been set to an hour, because if we're executing off 30-minute, we want context from the 1 hour chart. So double the time frame. We don't want it 4 time frames higher. That is just, there'll be a lot of lag. Well, we don't like lag. So the first thing I'll do is I will remove some lines here, which will add a bit of clutter before enabling this. So I will disable the daily VWAP, weekly, monthly from the style tab here. And then I will enable the super trend strategy M30. And this is the decision-making framework, by the way. I can change the title to something else if you guys want, but I just want to sort of highlight that it's for the M30 time frame, and it's based on the super trend strategy, but also something else, which is wonderful. Let's enable it. Flip over to the 30-minute time frame. And just because I'm going over to the 30-minute time frame doesn't mean it only works on the 30-minute time frame. It works on any time frame. But you guys wanted an intraday plus swing combo. Some people don't like holding trades for 2, 3, 4 days. So that's exactly what this is. And here you go. This is what you have. You've got super trend. Firstly, one thing I want to clarify about the super trend that I've introduced here is it will look the same as every other super trend indicator out there. However, to match everything else, it's adaptive. Along with the AI module, it's adaptive to price action, but not historic. Well, historic, yes, but also it's taken into account a specific measurement across trends and adapting to that. And the reason I can't go too much into detail about the logic that was used for an adaptive super trend is because if I do, someone will try to take, a base copy of open source super trend and give you a half cooked version of it, or God knows what else. So even though I want to get into the logic of it, I'm struggling to kind of refrain from it, but at the same time I can't, because if I do, I'm pretty sure someone will create a standalone version which doesn't even match the exact settings that I've got hard coded in the background, or the measurements, or the actual ideology behind it, because they won't understand it from my POV. And they'll start shipping it out as a standalone super trend indicator, but it cannot be standalone. So super trend is one aspect. What is super trend? When the trend shifts and a pivot is broken, it switches to either sell or buy. A lot of the times you'll see it's matching with the AI signals. So for example, this buy here, the AI signals alerted buy, super trend also alerted buy. Here, the same thing happened. However, how do you know whether to take this sell or this buy? And this is what's been introduced, and this is your decision-making framework. Range boxes. It's as simple as that. Now, it is as simple as that, but trust me, this took blood, sweat, and tears to get right. They're not even boxes, if you can see. They're not even boxes, they're sloped. Because they have to be sloped. You cannot capture a range in a box because price action keeps developing. So it was a pain for me to get this right. And then I had to map out 4 different ranges, right? You've got higher ranges because you've got, let's say for example here, you've got a range. Now you've got another range. Now you've got another range. So I had to map out 4 different pivot points for ranges. Range 1, range high 1, range high 2, range low 1, range low 2, if that makes sense, which are what you can see on your axis there on the current range. So you've got 4 ranges, the lowest range, the midpoint, and the highest range. Now, when do you know whether to take a trade or not? This is how visually easy this is. So this is the gold chart, and actually, let me go on. Let's use gold, seeing as we've used gold for reference this entire way. But there's one other trade I took yesterday, which I'll go through as well. You've got consolidation. Now, you take a trade when there's been a clean break outside of the range box. If you see there's been a massive gap and then it's consolidating, you would need a very strong bar close above the range to say, yeah, the trend is going to continue, I'm going to continue upwards. That's not what happened here. So here, we went into a brief consolidation period, a brief range, a candle broke out, but the next immediate candle closed back within that range. So if you did enter here, you would have closed it there as soon as it opened within that range. Now you can see it's changing direction. So you wait, you still don't take a trade because these candles, look, they're still small. There's nothing impulsive about them yet. Then you get a chop. Now here, the trend shifted, plus look how clean that break is on the M30 chart out of that consolidation box. It wasn't just a small break, right? So you wouldn't have taken it on this red candle here. That's too small of a break. What followed after, that would have alerted you. So at that point, you'd be looking at the chart. Then the next candle, you would have taken your trade slightly here because now you've broken out of range. You're continuing downwards. That's your entry point. Your stop loss, you could pick, let's say, the middle of the range. You could put, if you really want to be safe, you could go for the, the higher end of, let's say, this range. But even the midpoint before the move began, for example, here, you could have just put it above that swing high here, and then you would have basically traded this breakout all the way down. It went back into a range for a brief moment, another breakout. You would have basically traded this all the way down up until the simple move in average 200 level here, where it wicked off, and obviously it kept wicking around the major trend line here as well. So that's what's new about the decision-making framework: when to take a trade, when to execute, when to buy, when to sell, when not to buy, when not to sell. If you don't have a breakout, if you're consolidating within ranges, you do not take a trade. Here, you've got a breakout. This was a weak breakout that would have alerted you. This was your confirmation. You could have taken a trade there, put your stop loss around the midpoint. Again, brilliant trade. Exhaustion here, exit, you're done. That's what at least a 1-2, 1-3 in terms of RR. I say RR, risk to reward ratio, in case the abbreviation isn't clear. And let me go through an example of the trade I took yesterday off the back of that range break. And it was during the Asian session where I took this trade. And it's not great to take such a trade on an asset like the D40 or DAX or the GER 40 or the GER 40, GER 30, whatever you want to call these indexes. There's various different naming conventions for them. For example, here it's D40. On your broker, it might be DAX, but basically it's the European. It is one of the European indexes. So I took a trade during the Asia session for a European index. Not great, but here's why I did it. This is when I took that trade. So that was a clean break out of this long consolidation phase. So I say long, but it's only been consolidating for about 2 hours or so. So it was ranging, not 2 hours, let's say 3 or 4 hours, but it was ranging. And then we finally, you can see just visually, it's sloping down already, right? But you still need confirmation. So this candle break, when I was alerted with one of these alerts saying range break, and they do absolutely spam, by the way, at times there's no way of preventing that, especially if you've set it to the 30-minute time frame. Every single time there's a range break and an opportunity, it will alert you. But obviously you're sensible enough to know you don't take a trade at 9 p.m. market close when New York's just closed. And similarly, you don't take a trade, with 5:30 a.m., let's say the UK time, or 11 p.m. Eastern, because that's roughly when the Asian session is being, is losing its volume and momentum closer to those hours. So yeah, you're sensible enough to know not to open a trade at 9 p.m. UK time, which would be the time for New York market close, or late New York session. I don't need to explain that part, but yeah, back to the trade. So it broke out here. I entered the trade on this exact candle. So this closed, I was alerted that, hey, that we've got a range break. I waited a few seconds, and as soon as this next candle started turning slightly red, I took that trade and I put my stop here, middle of that range, middle of the range box right here, which also coincides with this old trend line that was left behind. But yeah, so that's where I put my stop. Now, the stop was, if I remember correctly, it was around 24,044, if I remember correctly. So that's where I placed the stop. And this was my entry around 23,910. And I targeted this area here. So there was a big bullish brain zone printed here, as you can see right here, big fat one. And this was bound to act as a price magnet the moment that pullback began. So this was just a pullback trade. It wasn't a trend shift, it was a pullback. But do I care what type of trade it is? No. I just care whether I'm getting my risk to reward out of it or not. As long as I'm getting my minimum 1 to 2, 1 to 3, 1 to 4, whatever you set your expectations to, as long as I'm getting that, I don't care if I'm trading a pullback or if I'm catching a big wild trend. That's the whole point of trading an intraday and swing combo. You don't care about holding a trade for 3 days. You care about securing your rewards as opposed to your risk in as little time as possible. And if you're trading off the 30-minute time frame, you want to be holding a trade for maximum, let's say, a full day. So that will be 3 sessions, but even then 2 sessions, and you should already have your take profit, or you should realize that, hey, there's not enough volume, momentum slowing, we might get a chop, it's been 2 sessions, I'm in profit, let me just exit. That's how you do it. But I set my TP to 23702, I set it at. It did go slightly lower than that, but the reason behind me setting the TP there, I didn't expect it to have a full-blown correction because it was a trade during Asia. I had no idea what was going to happen during, UK morning, during New York the next day. So I had a very conservative target. The top end of the big bullish brain zone that was left behind. So I looked at the top end, but now here's where the mitigated ones come in. And this is why these are never removed from the chart, and I've left them there deliberately. Even if brain zones are mitigated and they go gray and they're not red, they're not green, they're gray because they've been mitigated, they're still acting as price magnets. They're still acting as supports. So as you can see, that was historic. It was already there. I could do a bar replay for you here, actually. Just to show you exactly what I mean by none of this repaints and everything stays on the chart. Let's do a bar replay and see how this all formed. There you go. You can watch it in action. You can watch how the ranges are playing out. What happens when ranges are broken. There you go. Impulsive move. That created all of those, mitigated all of these. At that point, all of these were mitigated. They were turned gray. And this was the trade I took. And let's pause it here. Now, this was a trade I took. Where did it stop? Where was the exact point? You see this gray one here? So in between the top end of this big fat bullish brain zone and the lower end of this old mitigated gray one, right in the middle, you would have seen that move fade and that move end. But I'd set my take profit conservatively, like just slightly around here. It was 23702. I remember that off the top of my head. That was the exact take profit level. And it hit that. And then it continued slightly lower to about 2367E, but do we care? No, we don't, because we set our stop loss here. We took profits here. That was an easy, I think it was roughly a 1, 2, 3 in terms of risk to reward. So risking, that's 1% for 3% gains. And if you go for a 1, 2, you're obviously risking 1% of your portfolio for 2%. But this move was a lot more than 1 to 2. And the time frame that happened was within, if I took the trade, I think it was around 3 a.m. or 2 a.m. But let's say, yeah, from around here. So it might have been slightly earlier, actually. Can't remember now. But from 1 a.m. up until 2 p.m. So 11 hours, you would have had your TP and you would have been out of there. So that's your intraday plus swing strategy combination. Now, if you want, you can add your VWAPs back. I know, but I wouldn't add the daily. The reason I wouldn't add the daily is because the daily uses red as the color to track. That's the color of the red VWAP line. It's red. And that can sometimes overlap with the super trend buy and sell. I would only enable weekly and monthly. They have the most relevance anyway. in terms of price magnets and what's respected and the actual fair value of an asset. And when you get impulsive moves, you're more likely to hit the weekly and the monthly VWAP levels before it bounces rather than the daily. The daily just accounts for, that 24-hour period, and I don't really find it very useful. So yeah, that's in short the strategy. Now, one other thing is Confluence. So this toolkit is also about Confluence, right? If Supertrend says buy, if the AI signal prints buy, if it's left the range box with a very strong candle, that's Confluence. That's the solid trade, as you can see here. Same thing here. If you're bearish, if you've got a sell, you have to judge whether you're late to the move or early. On this occasion, this super trend sell would have printed late because you've already printed a bearish brain zone way ahead around 1 a.m. sort of how many hours before? A good 7 hours before, so you're already late to the move. So then your risk to reward isn't great. But if you did want to use that as Confluence, you had a range break here. That in theory would have been a good move. So super trend would have said sell, the range break would have occurred, and then you would have had a move. But what do you have here? You've got a bullish brain zone acting as massive support and a massive area of imbalance. So you would not have taken this trade knowing this big beast is under you. When you're within a bullish brain zone, look for bullish trades. When you're within a bearish one, look for bearish ones, unless they're mitigated and they turn gray. It's as simple as that when it comes to brain zones. That's how you treat them. That's how you use the context and the structure. So if we go to another example, here, super trend print sell, AI signals print sell, you exit consolidation, the range breaks. You could have taken this trade for at least, let's say, 2 hours, but it wasn't favorable because of this impulsive candle. And that's because we're looking at a very small time frame, right? So we have to be very selective in what we're looking at. For example, here you had super trend buy, you had AI signals saying buy, you also had a range break. Great trade. And if you really wanted to, you could have held this trade for like 2-3 days, and that would have been your entire month's payday. Done. Just one trade. So that's how powerful these range breaks and these range boxes are. I'm not going to go into the logic behind how these work and how I've actually gone and put these in there and coded it and the rest of it, because I don't want anyone to know, and it's as simple as that. And that's purely off the basis of this is supposed to be exclusive, which is why the toolkit was offered for free as a New Year's gift between January 1st and January the 9th in my old group. And after that window, I think 140 or 150 people got in. And because we had to maintain exclusivity, then there was a price tag added to it of $400 if you want lifetime access to the toolkit. And there will only ever be 1,000 people getting access to this toolkit in the entire lifetime of it. I will never create another toolkit. This happened by accident. I was building a gift to give out. I started, and then my brain went nuts, and this toolkit became way bigger than it was ever supposed to be. So as a result of that, I do need to maintain exclusivity now, because and only 1,000 people will ever get access to it. After that 1,000 milestone is hit, that's it. Even if someone wants to then, start paying $4,000 for it instead of $400, the answer will still be no, because the problem here is with everything else we've got going, the AI module, the machine learning aspect, the toolkit, the confluences, the entire everything you're seeing here. If too many people have access to it, algorithms aren't stupid, market makers aren't stupid, people will adapt. If 80,000 people, if 100,000 people started following the same strategy over and over again, rinsing and repeating, you can be sure at some point that pattern will be picked up somewhere. That is how markets evolve. That's how institutions base their algorithmic systems. It's to profit off predictable patterns. And that's what we're breaking here with this Confluence-based toolkit. We're breaking that pattern. We're entering on confirmations. We're not entering in between algorithmic chop, especially if you can take trades during Asia, which is renowned for algorithms messing around and taking stops and sweeping liquidity. If it's working during, hours such as during Asia, it's powerful. I don't want too many people to get access at any point. So yeah, it's as simple as that when it comes to that. Now the other part to cover is alerts. How do we set alerts? So I've got it set in a very basic way. So I've got super trend. So I've got a watch list. Firstly, I've got a watch list created. I've just named it cash, stocks, gold, of only the select assets that I'm interested in, and I've created a watch list. Then what I've done is I've gone into TradingView. I've created an alert with the condition would be the indicator. So you select the indicator here, which is Johnny's calculated brain, as you can see. The condition is super trend buy or sell. So whenever these super trend buy or sells print, and the interval I've set it to 30 minutes. So it's looking at the 30-minute time frame. If you want to set it to hour, 45 minutes, 2 hours, 4 hours, whichever you want, you can set it to that. But one thing I need to clarify is the super trend aspect of it is optimized for the 30-minute time frame, which is why it's the M30 strategy. Because the super trend and the tracking of the pivot points and the optimization of it so that it's not lagging is optimized for the 30 minutes, so it's as reactive as possible. On the 8-hour chart or the 4-hour chart, this might slightly lag because it's optimized towards the 30-minute time frame, and that's specifically for the super trend aspect of it. So the super trend sells and the super trend buys. The AI signals, they're not dependent on that, so they can be set to any time frame. The range breaks, they're not dependent on that. They can be set to any time frame. So super trend buy or sell must strictly be on the 30-minute time frame. The trigger must not be once per bar. You'll get absolutely spammed and you'll receive alerts midway before a candle close. You need to set them to once per bar close, so that once a candle closes, only then you're alerted off the back of confirmation, not midway. For the range breaks, you can set them for the range breaks, which are the range break boxes here. This is, by the way, the decision-making framework, the range breaks, along with super trend if you want to combine it for additional Confluence. The range breaks you can set to any time frame. They're optimized for any time frame. Again, once per bar close, open, end alert. You set it to whatever time frame and you save it. And then the outcome would basically be something like this: super trend buy or sell on whichever ticker, range break on whichever ticker, and that's when you know whether to look at a chart for a potential opportunity or not. And just to show you the decision-making framework and the ranges and the breakouts on a higher time frame, let's just use the European index here that we've got. On higher time frames, they also work wonders. For example, you had a strong break here, super trend shifted around here, but obviously super trend, as you can see on higher time frames, it is laggy because it's optimized for the 30-minute time frame. But you had a range break here, great trade. You had a range break here. However, if you look at the broader structure, this was basically just a pullback, so I wouldn't have entered this. If you zoom out, sometimes if the candles look bigger, they look like great trades. Make the candles smaller, they don't look like such great trades. So this was exhaustion. You had a break here, that was tradable. You had a break here, that was tradable. So basically, once you've got an actual breakout, here, for example, you had a gap down, perfect. Once you've got a confirmed breakout out of these ranges, these range boxes, and these consolidation phases, only then take a trade. That's a strategy. And obviously you've got your confluences with AI signal alerts, the bullish or bearish brain zones. And also, one thing I forgot to cover, you've got dynamic supports and resistances. So these green dots that you see here and these red dots you see here, these supports and resistances are dynamic and they build up along with price action. So that's something else you have to use for stop losses, take profits, and so on. So finally, we have concluded on this, and I've finally managed to get it done after falling unwell, which delayed it for a bit. Then I didn't really want to go off the script, so I had to re-record it a few times, and finally now you'll be watching this. So thank you guys for watching. If there are any questions, let me know, but hopefully it has explained in detail, the concept behind how this all works and how it comes together. So by default, your settings will basically be like this. These will be your settings. If at any point you want to revert back to what you are already using, that's very simple. Just go over to the 4-hour chart, let's say, go into your indicator settings, disable the super trend strategy M30, set brain zones to 4 hours, go to style, enable your VWAPs, and you're back to the old toolkit without the decision-making framework. One thing I've done, by the way, and it's a good thing I've remembered this because I would have forgotten. The styles and the visuals, I've merged them so it's a lot cleaner and you don't have 100 different options. And even for the alerts, now you'll notice much fewer alerts. So let's just cover what these are. AI open positions, so AI buy and sell positions. Exhaustion, any, whether it's a bullish exhaustion or bearish, it just needs to prompt you to look at the chart. So that's merged. Super trend, buy or sell, either, whether it's a buy or a sell, you'll get an alert. Range break in either direction, whether it's an upward range break, downward, you'll get an alert. Structure, market structure shift. Break of structure, I've left these separate because I know some people prefer to trade continuation, and if they were to do that, they'd only set it to break of structure for continuation trades, not market structure shift, which are early indications of a trend shift. So you can have these separately, or you can have any. So if either of these occur, you will get an alert for a structure-based change. Brain zone logged, which is if a new brain zone appears, you'll be alerted. A brain zone retest would be if a previously formed brain zone is being retested, or if price is within that box. And any brain event is if either of these are happening, then it will alert you. So that's how much I've trimmed this down. So yeah, it's all very neat and tidy now. It's all great. You've got your decision-making framework on top of a very powerful Confluence-based toolkit, fully customizable. Play around, test out the strategy. It's great. It works. Trial and error this live in the group over the last 2.5 weeks, and I've literally put out there test 1, test 2, test 3 whilst I was testing all of this, just randomly throwing trades out there. So it's all live tested, and the reason live testing was so important is because back testing is great, but the past doesn't tell me how good my present is going to be or what my tomorrow will look like. So live testing was very important because, as I said at the very beginning, I was building a decision-making framework on top of this, and the only way you can prove a decision-making framework helps in making decisions is by using it to create a strategy that works, which we've been able to do. If I wasn't able to do that, it would just prove the decision-making framework is, essentially nonsense, because if it worked, why don't I have a working strategy? So because the strategy works, it proves that the decision-making framework does exactly what it's intended to, and that's help you make better decisions on your entries, on your exits. And I remember someone in the group saying the other day that they had a trader who kept moaning that they kept hitting stop losses on their trades. And they gave them one simple piece of advice, which was, hey, start placing your entries where you're placing your stop losses, and maybe you won't hit them. And the trader who was consistently hitting stop losses suddenly turned profitable. So what was missing for them? It was that decision-making framework. And that's why I've added it, and that's what V2 is about. So thank you once again for watching. Enjoy yourselves with the toolkit, play around, and hopefully make a lot of money with it. And, you know, I know you guys already do, and you're always in the group saying, hey, the indicator's great, and, you know, we're making money. I had someone in my inbox the other day saying they're in, I think it was Spain, on a beach holiday, and they were making money. So it's great to hear these things. Although, you know, I'm not one to boast about stuff like this. If it's making you money, it's fulfilling its purpose. That's what it's for. I'm happy for you. So yeah, have fun with it. And any questions, let me know. Thank you.